closing at session lows. The NASDAQ in particular is getting hit hard, down 1.3% or so. It's all those growth, momentum, tech names that are getting hit especially hard, like Tesla, Apple, Facebook, PayPal, Amazon, NVIDIA. Those are under pressure today with value and cyclical names outperforming. Time now for a CNBC News update with Rahel Solomon. Hi, Rahel.
Hi, Sarah. Hello, everyone. President Biden has tapped Vice President Kamala Harris to lead the White House efforts to tackle migration challenges at the U.S.-Mexico border. Two girls, ages 13 and 15, are facing murder charges because of a failed carjacking. Police say they targeted a 66-year-old man. The car ended up on its side, and the owner was thrown to the sidewalk and died at the hospital. Police in Virginia Beach say that they're unable to determine the motive for a 2019 mass shooting. 12 people were killed in a building where the gunman worked. Some victims blamed a toxic workplace and supervisors who did not recognize warning signs. And still no progress in moving that massive container ship that has halted traffic through the Suez Canal. 10 tugboats are trying to move it. Satellite photos show the 1,300-foot ship totally blocking the canal, which carries about 12% of all global trade. Heavy winds are being blamed. Just incredible. And to learn more about what's being done to free the ship and how long it might take, check out the news with Shepard Smith. Well, I'll send it back to you.
Rahel, thanks so much for that. Shares of DocuSign, the cloud-based electronic signature company, are up more than 130% on the year as the pandemic has digitally transformed the way we do business. But it's fallen 30% from its highs as investors question whether the growth can continue. The company hosting its annual customer conference today, showcasing the latest product capabilities. Joining us now in an exclusive CNBC interview is DocuSign CEO Dan Springer. Dan, good to see you. Thanks for joining us.
Thanks for having me.
So some extraordinary growth numbers looking backwards, and congrats on that. To what extent is that the traditional business of literally signing contracts versus some of the new areas you're trying to expand into?
Well, if you look at the fiscal year 21 growth, the year we just completed, to your point, e-signature really provided the lion's share of that growth. We grew the revenue 50% last year, and at our scale, this coming year we'll hit $2 billion in revenue. That's pretty good growth. What we saw in the pandemic, there was a need for people to get that first step into their agreement cloud, which e-signature oftentimes is, because there was just an urgency in the stay from home or work from home model. As we see going forward, we think that's shifting, and we'll see more of what we call broader DocuSign Agreement Cloud. So that's things like CLM, where we take people to that broader management of their overall agreement. So that's how we see the thing that's shaping up.
And I guess the question, Dan, everyone's wondering, I mean, clearly there is an ease of use, whether you're sitting at home or in the office, to do e-signatures versus physical signatures and scanning and returning. But when people do go back to the office, is demand for your product going to be lower?
We don't think so. When we take a look at what you referred to earlier as this digital transformation, and if we think about the digital transformation piece that DocuSign is powering, it feels like a freight train that's only going in one direction. People are not going to go back to sort of those manual processes, dealing with paper, having a much less, positive environmental impact than you would, with a digital solution like DocuSign. So the benefits of speed, the benefits of their customer having a better experience, it's pretty clear that once people have made that move, they're not going back.
So Dan, with that in mind, how do you think about how big your business can get, or as Wall Street's beloved metric, the total addressable market?
Yeah, well, we think about that TAM, or total addressable market, in two pieces. We talk about the core e-signature business, the one that, of course, we know very well, our strong leadership position, and really what sort of brought us to this dance, at about $25 billion and growing. And if you think about it, even though we have such a dramatic market share lead, it's still very early days in that business. As I mentioned, we're only going to hit about $2 billion of revenue in this coming year. So very early innings. From a standpoint of the rest of the DocuSign Agreement Cloud, or that overall Agreement Cloud space, we see that as about the same size, so approximately another $25 billion. So we see a lot of years at that high growth ahead.
Dan, to what extent do you rely on single big customers, particularly corporate customers, for your actual revenue? I mean, I'm a user of your product quite regularly, but I'm not a paid-for subscriber, so I guess my usage relies on somebody at the other end paying your subscription fee.
And we appreciate them doing it, as you would expect. To give you a sense of magnitude, we have almost 900,000 customers around the world. And we go from the smallest company to the biggest. And we really say over time, every company should use DocuSign. However, our larger customers, the ones that we have a direct selling relationship as opposed to ones that just come to us on the online model, represent about 85% of our revenue, even though it's a much smaller percentage of our customers. We don't have any concentration by vertical or industry, or any individual company for sure. So it is quite, diverse in terms of that need. On the other side, you described yourself, and we call you a signer as opposed to a customer. We've now had 1 billion people sign with DocuSign. So that's incredibly widespread as well.
One thing I've heard also about your stock, which is why a lot of growth managers like it, but also ESG managers like it, because it's obvious, right? It conserves paper to have to digitally do signing. Do you think that's a big driver of flows into your stock?
I don't know how to think about it from the investor standpoint, but I can tell you from a customer standpoint and from an employee standpoint, this environmental focus is big. At Davos 2 years ago with Jane Goodall, we launched DocuSign for Forests to really build off that core concept that by using our products, you're having a much more positive environmental impact. And we've seen that really take off. It makes our employees really proud to work here. And many of our customers like Walmart and Unilever come forward and say, we've got an ESG effort. We've got an environmental focus, and DocuSign as a supplier can now be part of that overall effort. So we see really positive feedback on both of those sides. From an investor standpoint, I think people check that box a little bit. Sarah, I don't know how much is actually driving all of their investment decisions, but clearly it's something that they're positive about us having.
Dan, thank you for joining us. Good to check in with you.
Thanks for having me. Cheers.
Of DocuSign. We've got 25 minutes left to go before the bell. Here's where we stand. NASDAQ approaching the lowest point of the session as we speak. Technology is under pressure. We're seeing the Dow remain higher, but again, well off the highs, up only 1/3%, thanks to Honeywell, Home Depot, Caterpillar, and 3M. Salesforce, Nike, Goldman Sachs at the bottom of the pack. S&P 500 has now dipped down 0.2%. It's weighed down by sectors like communication services, consumer discretionary, and technology. Up next, find out which Wall Street firm is paying out bonuses and raises to mid and entry-level investment bankers amid fallout from overworked employees at Goldman Sachs. We'll be right back.
Another update in the battle for work-life balance in the world of Wall Street. Credit Suisse executives telling mid- and entry-level investment bankers that they're getting special $20,000 bonuses as well as some raises. This move comes as corporate culture and work-life balance have been brought to the forefront by the likes of Goldman Sachs recently with their internal survey. That data, which surfaced last week, surveyed 13 first-year analysts, with the majority of them citing exhaustion, poor mental health, and 100-hour work weeks amid the pandemic. And Sarah, it's fascinating that this story keeps on giving more angles. And I have sort of two quick points, which is I wonder whether the Goldman Sachs bankers that are now being promised that they don't have to work on Saturdays would have rather got $20,000 or not. And with that, it kind of comes to the point, which is, you know, these are high-paying jobs. And if money placates your concerns, then it kind of suggests the complaint in the first place perhaps is a little overdone. And this is a job that you kind of comes with the trade-off. You're well paid, it's tough hours, and if you don't really want to take on that trade-off, so be it, you can leave.
Well, I do think that the different strategies and approaches to this issue by all the banks is notable. This is obviously the most generous, at least from what we've learned. Jefferies, I think, gave analysts and associates Peloton bikes or Apple products, which is also not bad. Jane Fraser said you don't have to Zoom on Fridays at Citigroup. And at Goldman Sachs, what? Saturdays, they didn't have to work. So it's interesting how they're all approaching this. And by the way, financials are one of the best performing groups in the market this year. The capital markets have been on fire, as you well know, right? M&As, IPOs, SPACs, you name it.
Well,
so why not reward? Even Janet Yellen, who's been one of the toughest critics on banks, says now they can buy back shares, she thinks.
I do think that's, by the way, one of the important points that we perhaps haven't brought up, surprisingly, given we've discussed this so much, of when all these complaints and then responses started to come out after bonus time. And I do think last year clearly was an absolute blowout year for the investment banks. We don't know exactly for junior bankers how much higher their bonus was compared to the year before or what they expected. And one guesses, particularly in the era that we're in, where banks couldn't be seen perhaps to be paying huge amounts out when other sectors and other people had such tough years, whether if they just got slightly fuller bonuses, we wouldn't have heard all of this even in the first place. But we don't know. That's speculation. But it's interesting that this timing, particularly from the Goldman Sachs survey, came so shortly after bonuses were paid. And maybe if they'd got that 20 grand up front that Credit Suisse Bank has just got after the fact, you wouldn't have even heard about this story in the first place. But anyway, great story. Keeps on giving us more angles. We'll see what we talk about on this front tomorrow. I'm sure there'll be some other angle. You can read more, by the way, CNBC.com, lots more on all of those developments over the last couple of weeks. Still to come.
And I'm sort of like Bruce Willis in Die Hard 2, where he's waving off the incoming flights.
Bruce Willis himself, Charlie Bobrinskoy, will be joining us to break down his bold call on one of today's biggest decliners that's down almost 20%. That's next.
16 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day as always. And today we've got Ritholtz Wealth Management CEO Josh Brown back as well. Welcome, Josh. We'll kick it off with the broader market. Stocks are getting hit hard here into the close. The Nasdaq and the S&P 500 are both currently at the lows of the day, down for the second day in a row, and also seeing this tumble into the close for the second day in a row. Mike, if you look at what's getting hit especially hard, yes, it's technology, media names, but also some of the reopening plays like airlines, hotels, leisure. What's driving this?
Well, I do think there's still a little bit of hesitation about exactly, the pace of reopening, but also in combination with the fact that getting very long, the cyclicals had become something of a consensus trade. You lost a little bit of the yield tailwind as the yields backed off a little bit. In general, though, the market has just gotten to a point where it broke stride in terms of the big momentum drivers out there. I think part of it, we talked about it yesterday, is retail trading flow has really diminished. You don't have the same amount of price insensitive kind of follow-on buying that you get in some of the growthy names that you had in the early part of the year. Plus, we got this quarter-end rebalancing we keep talking about out of stocks into bonds. So those are I think, the environmental factors. And also, we're up 70% in 12 months. And literally everybody said, once that happens, you tend to have kind of a choppier digestion period thereafter. So this is kind of what it feels and looks like.
Nice jump on Monday, Josh, and then, a couple of soft days. What's your take of what's going on this week?
Yeah, I think on the look, we made a new record high on the Dow last week. So, if your expectation is that you're going to just make new record highs every week forever, you probably don't belong in the stock market. This is, to me, this looks like a very calm on the surface market. And then I understand that beneath the surface, there are some rotations that look extremely violent. And if you have concentrated positions in the ARK stocks, for example, or the 50% revenue growth club, it's not fun, and it definitely feels much worse than what the broader averages are suggesting. So, look, I just think that that's where we are right now. It's interesting because you would have thought all this stimulus money, everyone was ready for this to pour right into Bitcoin and pour right into the meme stocks and Cathie Wood and Tesla, and all of those things are not rallying. So I'm not sure that it has a bigger, broader meaning. I do think it caught people by surprise, because that's what their expectation was.
Viacom CBS plunging today. The stock's down 27% in the last two trading sessions after the company announced plans to raise $3 billion from stock offerings. I asked Viacom CBS shareholder, frequent Market Zone guest Charlie Bobrinskoy about the stock's valuation just 2 weeks ago.
And I'm sort of like Bruce Willis in Die Hard 2, where he's waving off the incoming flights. I got to wave people off here. If you own it, it's okay to own it, but I can't tell you to come in at these levels. This is now trading with a lot of optimism, frankly, and I think it's still being helped by that short position. So we still own it, but we have reduced our position.
So, Charlie, that was a prescient call. Congrats on that. I guess, of course, I wish you'll be wishing you'd sold more than perhaps you did. But down 27% in 2 days, are you changing your mind now and starting to top up again or not?
Well, what's changed is that there went from a net short position where there was a squeeze and stock not available, and then the company issued a lot of new stock, and that put a change in the dynamic. And so there isn't that same kind of short squeeze. And frankly, what they did was they issued a convertible, a mandatory convert, and a lot of people that buy that simultaneously short the stock. And so the trading dynamic is just terrible here in the short run. But fundamentally, this is because the stock ran too far. I mean, it was trading it had gone from 3 times earnings to 22 times earnings. It was well above our valuation. We're value investors. We compare the stock price to our calculation of the intrinsic value of the company, and it got above that. And so that's just what's changed. Value investing is tough in the short term, but in the long run, things go to what they're worth, and this has come back to earth. It needs to come back some more for it to be attractive to us.
Well, just looking, Charlie, at the 12-month performance, Viacom CBS up 378%. Discovery is right down there with it today and has been right up with there, up 211% over 12 months. Why have we seen this crazy move in these stocks?
Because everybody hated it a year ago. This was the most hated name, frankly, maybe in the entire stock market. I mean, the stock was trading at 10 at 3 times earnings. It made no sense.
And all the bad things that people were predicting have been proven wrong. Paramount Plus has turned out to be a great success. Everybody thought they were going to lose the NFL. They didn't lose the NFL. Everybody thought sports were dead forever. Sports are coming back. Bob Bakish was hated as a CEO. Now he's loved. Being a value investor, you love situations where everybody hates it, which is where it was a year ago. And unfortunately, 3 weeks ago, everybody loved it, and that's not good.
So just round it off for us, Charlie. Are you still Bruce Willis waving people away, or are you advising people to get back in now, down 27%?
All right, so our valuation of the company is still below today's stock price, but we're in the hold zone. This is no longer dangerous. I can't tell you to buy it here. We sold a lot. We sold, frankly, close to 80% of our position. So I'd still tell people to be cautious here, but it's obviously a lot more attractive today than it was 3 weeks ago.
What'd you buy instead?
Some other names that are unloved. I mean, there are still some names. One of them we talk a lot about. People don't like Mosaic. People don't like Madison Square Garden Entertainment. Madison Square Garden Entertainment is selling for about 2/3 of the intrinsic value of Madison Square Garden plus Radio City Music Hall. The agricultural economy is exploding higher, and Mosaic is going to have a wonderful year. And people hate Smuckers, believe it or not. The peanut butter and jelly company, people hate it. That's what we love.
Charlie Babrinski, nice cameo in the Market Zone. Thank you for jumping on.
Thanks for having me.
Appreciate it. Let's talk Intel. The new CEO laying out his turnaround strategy for the company today. Josh Lipton with the details. Josh.
So, Sarah, Intel is back. That is how new Intel CEO Pat Gelsinger is putting it here, outlining a new ambitious strategy for the chip giant. One of the big announcements, Intel now determined to be a competitive foundry, meaning manufacturing chips for other companies. Gelsinger explaining why on CNBC.
It's a different market. As you said, $100 billion foundry market by 2025. And there really are very few companies that can step into that with leading process technology. There's also extraordinary interest on the part of US and European countries and governments for a more balanced supply chain. And again, we're one of the few companies that can step into that.
As part of this effort, Gelsinger says Intel is going to invest $20 billion in 2 new chip factories in Arizona. Still, some on the street have questions here, like Bernstein's Stacy Rasgon. A foundry business is something this company has tried before and failed, he says. Also, Intel, with this effort, is taking on a Goliath, TSMC. Remember, it's spending a ton of money itself, which Stacy says begs a big question for investors. How will Intel actually attract enough business, he asks, at the end of the day to make this plan viable? Back to you all.
Josh Lipton. Josh, thank you. It's been a big winner so far this year, Josh Brown. Down today, down overall for over the last year. What do you make of the new strategy in the stock?
I mean, it sounds great if they could pull it off, but if you remember why they stumbled over the last couple of years, it's been because of whack execution. Like, they're not good at making chips anymore. The other headwind that he didn't mention just now, but I will, is that we have a new class of OEMs making their own chips, and Apple is chief among them. And I don't see that changing on a dime, no matter how good or efficient Intel gets. It looks as though some very large tech players that were buying huge amount of chips from companies like Intel have decided that they can do it themselves in a more efficient way. And the types of CapEx that they've poured into that project, again, you don't just stop because an SVP from Intel takes you golfing. So I see that as a permanent headwind. And TSM is, I mean, they're just better at Intel. So I hope I'm wrong. I'm an American. I hope in 2 years Intel is better than they are and can really pull foundry business in. But the stock seems to be getting the benefit of the doubt that they're going to nail it, like in terms of how much it's gone up. And I don't think they deserve it. So that's where I am with Intel.
Major fade in that stock over the last 23 hours. It jumped 5 or 6% after hours yesterday. You can now buy a Tesla with Bitcoin. This, according to a tweet from Tesla CEO Elon Musk. He goes on to say that Bitcoin paid to Tesla will be retained as Bitcoin, not converted into fiat currency. Bitcoin currently right below the 55,000 mark, while the base price for the lower cost Tesla Model 3, which is the most popular model by sales, is around $38,000. Shares of